I encourage you still to share your comments in the chat. Raise your hand in case you have any questions, and Tony will be looking at them, but we should also be updating him. Thank you.
Okay, good morning, colleagues. I welcome you to today's training and webinar. My name is Tony Kalungi, as I've been introduced, and I'm going to be presenting something wonderful. Share the screen. So the issue that I'm going to be discussing is VAT and the income tax regime. And the topic is comparing the tax systems in the East African community. And then we'll be asking ourselves the question, is the value-added tax the solution to taxing the digital economy? Yeah, this is what we'll be doing. We'll keep the interaction. You can ask questions, then if there is a comment, we'll try to resolve it. If you want to submit, we'll continue as we'll keep it interactive as much as possible. So what we will be looking at today, we are going to be looking at the digital economy. What is the digital economy? Why is taxation of the digital economy a problem? What are the implications of the failure to tax this digital economy? Then we'll also look at globally, the historical perspective. We'll begin from the Ottawa OECD Conference in 1998. Then we'll look at the objective of the OECD in relation to the digital economy prior to the BEPS project. Then we'll look at examples of countries overtaking the development of the OECD. We'll look at the BEPS report, the final one, and then we'll look at unilateral actions of various countries regarding the digital economy. Then the examples specifically of value-added tax measures on the digital economy. Then we'll come here regional and compare the tax system in the East African community. Then we'll ask the question, is value-added tax the solution to taxing the digital economy? That's what we'll be doing. So if we begin the question today, I guess I'm going to be presenting and focusing on the slide, but in the event of any question that pops up in the chat, I would request for guidance to be referred to it, because I'm going to be focusing on the slide. So the question goes, what is this digital economy? We'll try to make it much simple as possible. If you look at Netflix, Facebook, Amazon, Google, Payway, Alibaba, all of that, everything that is digital, behind it, there is an economy. So simply, all commercial transactions we conduct on the internet, the selling, marketing, banking, supply chain management would all be the digital economy. But there's a specific definition by the BEPS project. Briefly, the BEPS would be, there was an aspect of the base erosion and profit shifting project. Now that project was set up by the OECD and it issued action points. So when I say BEPS, I'll be referring to the base erosion and profit shifting. So the action point 1 deals with the digital economy. And for it, it says this is a transformative process brought together by the information, communication, and technology, ICT. Briefly, that's the digital economy, but in simple terms, everything you see digital online and the internet, the transactions you carry out, that's the digital economy that we'll be looking at. So why is taxation of the digital economy a problem? Why is it hard? I mean, people will tell you taxes have existed, and there are even sayings from Roosevelt as far as the constants are death and taxes. Taxes are always in there and they will be there. But why all of a sudden the digital economy has come about, everyone is asking the problem. So the taxation of the digital economy is a problem because of various issues, but we'll frame them. There's one that is the nexus issue. The nexus, it's hard to, especially for various countries on the globe, to provide a connection of a particular digital transaction to their respective jurisdiction. Let's take a look at maybe Facebook. It could be that Facebook, maybe Silicon Valley, Ireland, or whatever, and it is used by various persons all over the world. How do you create a connection to your country to tax it? So there are nexus issues. It's hard. It could be argued that where Facebook is based, that's the country that should tax. Others will argue that no, where all the users of Facebook are based, then that is where Facebook should pay taxes. But the problem is that already international tax has a regime. And before the digital economy, there were agreements that came in that were reached. And one of those was that if a multinational enterprise carries on in more than one country, it should not be taxed by all those countries. It will only be taxed if it has a permanent establishment there. So the digital economy lacks that permanent establishment. It may have, Facebook has nothing in Uganda, but the users are there. So you can't physically, basing on the model tax it. So there is that problem of the nexus that has to be adjusted with the current legal regime. Then there's the problem of data. The data is immense. The data, the number of transactions, we are now using Zoom, but everyone is in their various locations. The data that goes on in the background and currently the audio, the comments, it's hard to be internalized and for you to come up with tax. So there are data issues. Then characterization. The digital economy has revolutionized transactions. People are making money and transacting in ways that we are not able to comprehend. So you can't characterize a transaction in the digital economy. If you do, it is hard to say. For instance, on Facebook, what do? You just log on to Facebook, you chat, but Facebook is making money. How do you know how Facebook is making money? Those are the issues that have to, people are advertising, people are commenting. So the characterization of those transactions was an issue. So that's why it was hard to tax the digital economy. Then the easiest thing about the digital economy, basing from what we have discussed, it has enforcement challenges. For instance, I'll keep using Facebook. Let's say Facebook. Let's say Uganda decides that we don't want to know these problems of the digital economy. Let us use Facebook and assessment. The issue will be how will Uganda enforce that assessment. Now the challenge with this comes in two ways. In international law, okay, international private law, that's conflict of laws. There's what they will call the Dicey and Morris rule. Now, Dicey and Morris, these were authors of the private international law, and they give a lot of rules. Now, one of them is that since states are independent, you can't tell a state what to do, and you can't tell its nationals what to do or not to do. So, ordinarily, you can't enforce your law as Uganda in the United States of America. So, if you pass a law, tax is a creature of statute, that we have chosen to tax Facebook, you're not going to go in America and you enforce it there. No, you stop on the map of Uganda. So that's the Dicey rule. However, this was also modified into the revenue rule, which is basically similar but limited to taxation. Now, the revenue rule is more specific. It will tell you that you can't enforce your debts of revenue in another country. Now, that's the general premise. And I think being a lawyer, I would use example. Basically, started from, there was a case of the government of India versus Taylor. So in the UK, they were doing a liquidation. Someone had not paid their debt. They were trying to close shop. So the government of that person, whereas they were in the UK, they had taxes that were not paid in India. So the government of India went in the UK to add their claim of taxes to be paid by the creditor. And they disagreed. Finally, the House of Lords summarized and said that the government of India would not of England would not allow that of the UK to impose its taxes there. So that is what came to be known as the revenue rule. Of course, with every development, exceptions came about. And to summarize them, the exceptions are that where there is consent of the host country, you have to seek permission of the government of, say, the USA, if you want to tax Facebook, and they agree. Now, this is why countries enter into double taxation agreements and then conversions for mutual administrative assistance. Or alternatively, if there is a domestic legislation in that country that allows you to do so. But the digital economy has enforcement challenges. No state is allowing you to tax its person, because every state wants to tax the most. The US may not allow you to tax a revenue that is going to be to tax money from Facebook. The challenge is that the moment it allows you to tax Facebook, it will have to give Facebook that allowable deduction. Now that's deep, but focusing on this, the problem of taxing the digital economy makes us data characterization and enforcement issues. Now, of course, someone might ask themselves, so what? You don't tax the digital economy, you can continue doing the other thing. Now, if you don't tax the digital economy, and when you fail to do so, that's what it leads to the best erosion and profit shifting of companies. And it's done mostly, the research was done on an empirical research and found out that most people carry out more BEPS using the digital economy by formulating subsidies and transferring them. If you try to go to the US, Facebook might tell you we have subsidiary in Ireland that is solely responsible for owning all the intellectual property of Facebook and even the you go to Ireland, they will tell you no. There's also another subsidiary that is in charge of dealing and has all the workers and people who formulate everything, and it is the Netherlands. So that most of the complex tax avoidance schemes are in the digital economy. The famous one we like to use the double Dutch sandwich. That one is common main digital economy. Two countries, Ireland and Netherlands. Netherlands taxes a lot, then the digital, if you look at Ireland, taxes less. So what people do, they form three companies. One in Ireland, the middle one in Netherlands, and the third one in Ireland, with a view that they are all subsidiaries. If you try to tax them in Ireland, they will tell you no, this subsidiary exists and it is Netherlands that is taxed a lot. So when it is taxed a lot, they tell you that amount that you have paid in Netherlands, give it to us as a deduction. But that's deep. But if you read and analyze their problems of mainly BEPS, if you don't tax the digital economy, and we are losing a lot of profit in the digital economy. So it's important to understand the substance, because what we'll be debating at the end has been covered before and solutions formulated. So if you're to do a chronological analysis taxing the digital economy, your starter has to be the Ottawa OECD Conference in 1998. So when the problems came about tax the digital economy, conference was held in Ottawa, and they agreed that fine, we may not know how to tax the digital economy, but let us agree on what to do. Let's set the to-do list or the parameters or scope of what to do. So they published a report, the Electronic Commerce Taxation Framework Conditions. And now they said, first of all, that if you're taxing e-commerce, it shouldn't be a barrier to development. Don't tax the digital economy to kill it so much Because if you look at the evolution, as starting from the tribal society, federalism, mercantile, and then when you come to capitalism, now we are in the post-industrial revolution. So the digital economy has enormous advantage. For instance, now because of COVID, we are able to conduct this. So they told states not to tax the digital economy so as to hamper development. Then they also said, whatever you do, your tax system should be certain and transparent in a way. Then you must also develop a system to tax the digital economy that minimizes costs. Now, later on, we'll discuss that this is the benefit of VAT. It allows you to tax the digital economy cost, compliance costs. You need not audit the entire Facebook as for documents. So you can just target the final consumer. Then also, it's set about Tower principles, which run through. Basically, they are the same as those Adam Smith in the Wealth of Nations. Basically, the principles, whichever law you choose, must emphasize the neutrality. Now, neutrality is important because whereas you're taxing the digital economy, don't try to treat them as if they are so different. Take them as a business and be neutral without overtaxing them or taxing them. Efficiency, certainty, simplicity, effectiveness, fairness, and flexibility. Then after that conference, they developed work that had to be done. So they formed the technology advisory group and they gave it a number of areas to look into. They looked in, there was the concept of a permanent establishment that had to be looked into. They told it to look at characterizing this income. Remember, these were the problems that we talked about of addressing the economy. In argument for the nexus, linking a business, linking a digital business, said the concept of a permanent establishment had to be looked into because the brick and mortar at that time that you had to have a physical presence, so they had to revise that. Then characterization of income, it was hard to characterize which is Facebook making money in IP, dividends, or it is also a business income. Is it property? So those are characterizing. Then transfer pricing issues, because coincidentally the digital economy is full of subsidiaries, and this is because of the global approach. Someone could start in any country, but they choose to expand, so they form a subsidiary, and that raises transfer pricing issues on how the subsidiaries deal with each other. Then, of course, tax residence. The residence was hard to formulate for digital economy. So that is what was at the Ottawa conference. They agreed to what to do as they are embarking on taxing the digital economy. Now, it is important to note that at the time, the OECD thought it was simple, and it had an objective of how to tax the digital economy. Now, the OECD worked on a double taxation conversion. Now, they started way earlier. Actually, the double taxation agreements precede the OECD. They started at the League of Nations, then the UN came in. When the UN came in, the developed countries formed the OECD, and they were looking at double taxation agreements. So, but the trick was you just keep amending what you have to deal whichever issue comes across. So their approach was that they would get the digital economy and fit it into the existing OECD model taxation treaty and just amend the commentary by explaining that this means this, this means this. Ideally, for a permanent establishment, they thought they would just amend the concept and say, let's amend together for what happened with the digital economy. That was their initial approach. Now, the problem came in when states started overlooking. States started a question that, because even after the amendment to the OECD double taxation convention and the international law, states analyzed that so that they were losing out in the money they would have made from the digital economy. It was not enough. They became more Oliver-twists. They asked for more. Now, the spanner in the works, the most famous one that came up happened in Spain, handling the okay. Now, this is also an example of a digital a transaction in the economy. Now, Dell makes computers and some laptops, some could even be those. So Dell basically has based in Ireland, then there is France, and then there is Spain. But what the transaction was, whereas Dell was based in Ireland, it would, when it was selling its other laptops, including other items, it would set up subsidiaries in different countries. Now, in this example, it set up a subsidiary in Spain, and the subsidiary was just an office to be more commission office. Say if you want something from Dell, you just go to that office, order, it comes up. Then the Spanish authority looked at this and saw an opportunity to tax. They argued that considering the volume of the transaction, they needed to tax the subsidiary. Now, the challenge was that basing on the OECD double taxation convention, you can only tax a subsidiary in your country if it has a permanent establishment. And permanent establishment means basically you have a physical presence and you're carrying on business. Those two are crucial. You have a physical presence and you're carrying on business. If you have a physical presence without carrying on business, it's a permanent establishment. If you're carrying on business without a physical presence, it's a permanent establishment. So in Spain, the subsidiary had a physical presence, but it was not carrying out. Because if you wanted to order for a laptop, you could go straight to Ireland and then it would come. So, but the Spanish authorities interpreted it for purposes. Now, the lower court, the one that is credited for raising that, said that it set up the concept of an online permanent establishment. It argued that fine, Dell, you're based in Ireland, you're outside Spain, there is no activity. You, the Ireland branch, carries on in Spain, but we are going to create for you an online permanent establishment and tax you. Of course, this caused uproar in 2012, and in 2015, the appeal and the decision came out. Now, the higher court, it maintained that there was permanent establishment on the basis of a dependent agent, because they treated the subsidiary in Spain to be, it was carrying on work for the Ireland branch. But still, the principle of a virtual P came up. People started arguing that this is simple, it could be used. So after that, tempers lowered and people started arguing that they need to do something to tax. Now the OECD had stopped on amending, so the OECD started going back and forth, find something to do about the taxation. Now this is what brings us to the project. I've tried to summarize on one page, but it will cover whatever is needed for this presentation. Now the BEPS project in full is the best erosion and profit shifting project. It started at the Ottawa conference that we looked at. Then just for the report, I analyzed it focusing on this topic. Now, what we have to credit the BEPS project for, that we tried to solve the problem of taxing the digital economy. We had a problem of characterization of the digital economy, and how did it solve this? The BEPS project provided the various business models that exist in the digital economy. Previously, we didn't know what goes in the economy. but they provided various models. They explained that there is e-commerce, which is basically customer to, business to consumer, and then business to business model. Now, this one is important because the VAT, value added taxation, uses an example of the business to customer. Let's take an example of the distribution chain. If you sell to a final consumer, that will be the consumer. But if you sell, let's say a wholesaler sells to a retailer, that's a business model. And this exists on e-commerce a lot. Alibaba, they could sell to you, but you could import something to the platform, or you, and then you later on distribute it. Or a consumer can order online, come directly. So those are the business models. So people were able to know what good. Then it goes to also cloud computing. This typical example is this Zoom we are using. Now you could have a platform that is an infrastructure as a service. Zoom enables us use it to communicate, discuss, and then you participate or contribute. Or you could also have a platform that is a service itself. Or you could have also content be the service. There are online classes that I've seen that are automated. Then there are platforms that just do the service. You could use, say, I don't know, Uber might provide the service. Then you have payment services. You can pay online, Bitcoin, Visa. Then there is high frequency trading. There are trading whereby they are of low value, but they are, when you bundle them up, they become many. Those are the high frequency. Then online advertising. So we're able to understand what business model is in the digital economy. Then it also told us the features of these business models to understand them. Basically, there is mobility of business users. They move a lot. Someone could even be on this call, but outside Uganda. Then there are functions and assets. They are mainly tangible. You can't touch it. There is a lot of intellectual property there. Then the importance of data. These arrangements survive on data that is used, how you collect and analyze and store the thing. Then there are network issues. In fact, it is said that without the internet, there would be no digital economy. Without a network, there would be no digital economy. Then there is the possibility of a monopoly. Yeah. If you look at Facebook, I think Facebook started as Facebook, but now if you look at Instagram, WhatsApp, there are other platforms that exist. So it's possible to have them. Something you do alone, like Twitter, then volatility. There are no barriers on how you enter and exit digital transaction. Then there's also trading. So the BEP project painted the picture, demystified the digital economy, and we were able to understand it. Now, to indirect taxes, the BEPS economy came up with VAT proposal. Now, the BEPS acknowledged that this, when you look at indirect transactions in the digital economy, you can use VAT. You can use VAT, and the VAT actually model evolve the guidelines, take care of how you tax transactions. They exempt some and allow some of them. Then for direct tax matters, this is where we have the issue, because the BEP kind of provided guidance. Indirect tax matters, VAT, and those, but for direct tax matters, they remained an issue because the problem still existed. The nexus, the physical presence, the data, to understand the data, so those were still issues. And then how to characterize this data was still there. So there were still policy concerns that had to be done. Of course, recommendations were made For instance, the permanent establishment state, that's when Article 5, Clause 4.1 came in, whereby they said that whereas you're involved in activities of preparatory and auxiliary nature, if at all they look at them and they analyze that a presence exists, then you'll be taxed. Then, of course, transfer pricing guidelines came up. Yes. So there were also controlled foreign companies. CSOs. If there's a company that you control, basically let tax bodies know, declare the same to enable them to tax it. So it also, however, did the two ways. It was emphatic on other proposals and amendments of the permanent establishment, but quietly it told states that there are other options that exist, but they could be taken domestically, and those options would not be taken on an international platform. So they said you can choose to domestically change the nexus test and you create a significant presence, or you could impose withholding tax on digital transactions, but that was domestically uh, and not on a national platform. So I saw some, I'm going to, sorry for that. I saw some comments. I wanted to look at them